Can I actually make the mortgage industry a success using smart tax strategies? Smart tax moves can be a total game changer in the mortgage industry. By exploring how to leverage tax strategies, mortgage businesses can significantly boost their success and profitability. It's all about making the most of every dollar, and that's exactly what we're going to dive into today. Mortgage businesses face some tough challenges, like fluctuating interest rates and tight margins. These can really squeeze profits. Add to that complex regulations, and it's clear that every dollar saved through tax efficiency is crucial. Managing finances isn't just about cutting costs, it's about smart financial planning. Tight margins mean that even small increases in expenses can quickly eat into profits. And when interest rates fluctuate, it can be hard to predict cash flow. This unpredictability makes it essential for mortgage businesses to have a solid handle on their finances. Complex regulations add another layer of complexity, making it vital to stay on top of tax obligations. Without a clear strategy, it's easy to miss out on opportunities to save. But with the right approach, mortgage businesses can turn these challenges into opportunities. By focusing on tax efficiency, businesses can free up more resources to invest in growth. Understanding tax strategies can seem overwhelming, but it doesn't have to be. Let's explore some specific smart tax strategies that are relevant to the mortgage industry. For example, deductions for marketing and lead generation can be a big win. Many mortgage businesses spend a lot on marketing, and understanding what can be deducted can lead to significant savings. Depreciation of assets is another area where mortgage businesses can benefit. This can include everything from office equipment to software. By understanding how to depreciate these assets, businesses can reduce their taxable income. Entity structuring is another strategy that can offer significant benefits. By setting up the right entities, mortgage businesses can minimize their tax liability. For instance, a mortgage company might write off a portion of their rent or utilities as a business expense. They could also consider investing in technology that can help streamline their operations and reduce costs. These are just a few examples, but the key is to find the strategies that work best for your business. Let's consider a hypothetical case study. Imagine a mortgage company that was struggling to stay profitable. They were spending a lot on marketing and lead generation, but weren't seeing the returns they wanted. By implementing strategic tax planning, they were able to identify areas where they could save. They restructured their entity and took advantage of deductions for marketing and lead generation. As a result, they were able to significantly reduce their tax liability and free up more resources to invest in growth. This wasn't just about cutting costs, it was about making smart financial decisions that would drive growth. The aha moment came when they realized just how much they could save by being proactive about their tax planning. The potential for success and increased profitability is immense when mortgage businesses proactively manage their tax obligations. By understanding and leveraging smart tax strategies, mortgage businesses can turn challenges into opportunities. If you've had experiences with tax planning in the mortgage industry, share them with us in the comments. We'd love to hear about your successes and challenges. Don't forget to subscribe to our channel for more financial insights and industry tips.